Welcome to Opales TV. Today I'm in Singapore, together with Tom James and John Collis. They are the two co-founders of TradeFlow Capital Management. TradeFlow Capital Management is a trade finance fund which is actually revolutionizing the trade finance sector. And they're doing this in two ways. Number one, they have built the world's first digital, completely integrated business infrastructure for trade finance. And secondly, they have been annualizing a 6% return, however, without lending money.
I've been in the commodity industry now for 30 years. Had quite a holistic career, managing to trade, manage risk management, manage trading teams, work with the trade finance project, finance areas in banking, and also having worked for some big mining and physical trading companies as well. And also written a lot of books and papers on commodity trading and risk management, which also has enabled me to have a lot of interaction with the industry, and through that also met up with John.
My name is John Collis. My background, unlike Tom's, I was originally at Ernst & Young as a trainee accountant, and then I cross-qualified as a lawyer. And I went to the International Chamber of Commerce, and then I worked in the City of London doing international trade and international company commercial and arbitration work. And it was through that my path crossed with Tom. And Tom, some years ago, identified a problem with the commodities industry for SME traders. And that was what led us on to setting up the fund.
Exactly, yes. So I mean, the trade finance gap is huge. I mean, it's $1.5 trillion by official figures. Within that, there's probably 700 billion of trade in bulk commodities. So these are the raw, fundamental goods which drive the economies. Agricultural, base metals, energy products. And the biggest problem there is that the size of the transactions isn't always big. In fact, we found a large number of transactions are typically below $15 million per trade. And because post-2008 banking crisis, lots of changes, banks lost and were forced to get out of commodity trading, they lost a lot of skill sets within the banks, changes in the Basel regulations for capital requirements for banks, meant that although banks wanted to lend to some of these smaller traders and end users and manufacturers that needed to import these various products around the world, often it was not cost effective anymore for the banks to do so. So alongside that though, there's also a very large chunk of SMEs who have the expertise, huge amounts of expertise, often management that have left much larger organizations, but the entity that they've set up doesn't have large capital or enough audited track record, less than 3 years track record perhaps. And so the banks know these people, would love to lend to them, but can't yet support them. So there is this quite a large segment as well, these SME bulk commodity traders, which are not served properly yet. So when we were analysing the problems the banks had in lending and the small medium enterprise firms were having in borrowing enough and getting the leverage they need to move these goods around, the answer actually proved pretty simple, that don't lend the money. But the answer was don't lend money, so what do you do? So you'd have to make the fund principal, a middleman between the suppliers that want assurance they're going to get paid and the end buyers that need to prove that they've got the money to do the deal. And so that was the simple bit, right, John? And but the execution of that took quite some time.
one of the key things that we identified was that the problem between the funding that the SMEs required and the lack of it wasn't an idiosyncratic thing, but was actually a systemic problem within the banking industry and associated specifically with credit and lending. And that's what led us to work out how to approach it. We then spent quite some time working out how you could structure legally a master agreement and scheme so that suppliers and buyers could feel secure that our role was merely that of a financer, of someone enabling their trade, and not a quasi-trader trying to take advantage of their position.
Yes.
So we developed a system and a service that is collaborative with the banks and collaborative with the traders and not competitive with them. So as we identified, where we work is in supply chains. So these raw material commodities that are repeatedly being traded from place to place, and the transactions are repetitive as well, and for very small margins. So what we're doing is enabling these smaller traders, and when we say SME in commodities, we mean people with a turnover up to about $500 million a year. So very substantial businesses, but taking very small profit margins on their transactions. And that means that in enabling them and helping them and investing in those transactions, we also have to take very slim, efficient margins. And that was what led us on to working out how we could do that efficiently and the digital model. And Tom, yes, you worked through all the
That's
digital
right.
side.
I mean, the answer is simple, but doing it as a fund manager and actually making some money out of it for your investors is another thing. If we took the normal approach as a principle in between the trades, you could imagine easily 200 pages of bits of paper for every single cargo at least, right? And that's moving around everywhere. And you've got to get someone to actually take a look at all of that. So making it digital would remove that massive potential human administration work which would be required. And although you might be able to do it, you just wouldn't be able to do it efficiently. So we've looked at using electronic bills of lading, electronic contracts, our own risk management system, which we're giving to customers as well. The end buyers, we typically refer to as customers as well, as a kind of a service. So by giving them these tools, they are empowered to actually manage the transaction more efficiently, and also probably proper risk management tools. And then we are more focused at the monitoring risk management position. So this makes it scalable. If you've got the trader and giving them the tools where they can manage the trade, it's their deal after all. They've arranged the deal. We didn't. We've just stepped in to use our balance sheet of the fund to make the deal happen. And we can then sit back and monitor and just fight and firefight any issues that crop up. The interesting thing is that this brought up some issues around the legal side of the shipping. If we bought the commodity, we own it. Okay, great, but
practically we had to control it. And so what we ultimately designed was a master agreement where the supplier and the buyer sign up to our master agreement, which recognises us as an independent principal who interpose between the supplier and the buyer. So the buyer and supplier have already agreed their contract and how much they're going to buy whichever commodity it is for and on what terms. We then are like a wafer. We slip between them, and the contract between the supplier is with us on exactly the same terms, and the fund finances it. We simultaneously enter into a back-to-back contract with the buyer, selling it to the buyer on those terms plus our profit margin for financing the transaction and paying for it. What this means is, of course, that we're not actually lending any money at all. When we buy the commodity, we own it. When we charter the ship, we are the charterer of the vessel, so we control it. We can speak to the master. And then if there was any problem, the buyer end, so if we saw difficulties ahead, we wouldn't have to rely on our buyer or anyone else to speak to the master of the vessel and say, please will you not dock there or not unload in that port. We can step in immediately and redirect the vessel because we own what's on it and we have chartered it. And that is, when people talk about lending, they talk about perfection of security. Well, you can't have a more perfect security than owning what's on the vessel and owning the charter party.
So, I mean, through all of this, we have been able to construct for investors, a scalable, access to the trade finance asset class, which we put ourselves under because we're enabling these trade finance transactions. But also underneath that, SMEs and bulk commodities, which are the raw, lifeblood of economies, and non-credit. So, we're giving you further diversification as an investor, in a very stable asset class with low default rates anyway. And then we're removing even the risk there of, in a default situation, we control the asset. We don't have to go and prove a lien in a court somewhere and wait potentially days, right?
So Tom and I both know from our experience in the industry, and me as a lawyer, there could be quite a time gap between the problem arising and you actually securing a court ruling saying, yes, you can get the goods from the ship, by which time, of course, they may have disappeared or the ship may have disappeared. And really all you've got is a court order and maybe a claim against your insurer if you're sufficiently insured. So we've avoided that. I think one of the key issues that Tom and I worked on was how to do this at scale and in an efficient manner, because otherwise you'd have a back office team of hundreds if you did this in the traditional way.
Exactly, yeah. I mean, just even the KYC AML.
Well, that's right.
That can usually take a very long time.
So for most banks, when you onboard an ordinary customer, it could be anything up to 6 months because they have to get together sufficient files to justify getting a committee together to review them in order to onboard them. What we've done is we have a digital know your customer system that enables us to onboard clients and counterparties to the same level of security and knowledge as a bank would use, if not better. And we can do that, I think the quickest was 3 hours, wasn't it, Tom?
Yes.
And once they're onboarded, we then use industry standard anti-money laundering and sanctions checking software so that all the issues that can arise about where cargo's going to, where it's coming from, what it is, who the people are behind the companies, will all be checked out automatically but by the software.
KYC was always flagged by banks as probably 60% of the problem, and the cost of KYC, why good deals would be turned away. So we've got rid of that problem. The next problem, of course, is if you're looking at volumes of transactions and quickly turning them around and approving them or turning them down, how do you do that? Now, as we're not lending money, we're able to focus on the underlying transaction. As John said, the commodity, where it's come from, where it's going to. Is there a spot market in that raw commodity? Because we will look at a daily price and mark to market these products. And that all goes into our proprietary scorecard system. So we believe we're probably the only people in the fund industry context who have been able to now not only scorecard the counterparties, and that's both from an operational qualitative standpoint and quantitative standpoint, but then each and every transaction is able to go through our cookie cutter transaction scorecard. And then that is what creates and generates the prepayment requirement. And that's the prepayment, the skin in the game from the end buyer, which is our buffer. So because we're swapping pure credit risk for more kind of operational risks. Majority of those are insured anyway in the real world. The commodity, the ship, everything's insured. So the only other real risk there is in the case of a default, the end buyer defaulting, and that might be an operational reason. They've got flooding, warehouse problem or something. It could be a credit problem, but many other things could occur there where they just cannot take delivery. We have that prepayment, that buffer, that margin, which protects us from potential price risk when we resell the cargo.
I think it's quite important to explain, when we say prepayment, it's actually a trade facility fee. So this is a fee that the buyers have to pay to us for providing the facility, the finance to do the transaction. And it's made up of a number of components, which might be a proportion of the purchase price, the freight cost, the insurance cost. But its calculation is dynamic and it's weighted differently for each transaction. Just in the same way that we scorecard the transactions, those are dynamic criteria. So the weighting is never the same exactly on one transaction to another.
Depends where the commodity is going to.
Yeah,
I mean,
exactly.
Where normal lenders would have concentration risk with the actual counterparty and have to look at their balance sheets and try to keep up with that information. Our concentration risk is very much focused on the commodity and where is it going. Because that's our main security, and in the very rare event of a default, we're going to sell that commodity hopefully close to where it is or move it somewhere else relatively close. We don't want to be over-concentrated in one port on one commodity if there's only one buyer in that port. We would be asking for a pretty large transaction facility fee, prepayment, if that was the case, because there'd be a high risk of trying to dispose of that.
Yeah.
So how do you actually select the trades and the deals you want to get involved in?
One of the big sort of slowdown issues around traditional reviewing of transactions is the vast amounts of paperwork and the complexities of the physical transactions if you're reviewing it one by one. So what we've done is developed a scorecard model. So based upon our team's experience in commodity trade, risk management, the legal aspects, general risks, operational risks, sovereign risks, we've been able to look at many different dynamics, put that into a model, which we've now been running for 1.5 years, live with our fund. And this allows us to immediately process a transaction, so the vast amount automatically, without any human intervention. And that spits out, okay, you must put up 20% transaction facility fee as the end buyer to do the deal. And within that is going to give enough margin to protect us against any price risk fluctuation in the rare event of a default. potential delays of shipping at the destination port, and this is all data that we have available. We actually are able to real-time track shipping as well, so we're able to see if there's any deviation or problems or potential additional expenses. And the key thing is that this scorecard feeds then into our risk management in terms of looks like a clearinghouse. So we get the initial upfront fee, which is our margin there to protect us in a default. But then every day we're monitoring, is the commodity price going down? Now, in truth, there's no statistical link between prices going down and then someone's going to default. These are supply chain deals, and they're all up to maximum 90 days, so they're quite short tenors. And even in 2008, there was a very, very minor increase in defaults in trade finance back then, because these are margin deals. These are not speculative deals where people are trying to move stuff to hopefully make some money. This is going into manufacturing, processing, etc. And so every day we're monitoring the price, but if prices start to ease off, then if 75% of that initial upfront fee is utilized, we can call them for additional buffer, cash buffer on that. So this way we're able to really margin and control the risk to the fund. In terms of what we don't do and sectors that we're involved in, so the key thing is that the transaction scorecard only permits deals to go through if they are a raw bulk commodity, where there is a spot market, where there is prices available, and so that's non-perishable goods, non-finished goods. So these are the raw materials, either raw agricultural goods, dry goods, non-perishable, not livestock, not TVs, not Ferraris. And so this means that that is, there is a large enough market in this bulk commodity space to serve us in terms of capacity. There's no shortage. I mean, there seems to be many billions of dollars worth of capacity, even with banks that we cooperate with and their customers. So in terms of capacity of the fund, it's mind-boggling numbers actually. I mean, but the fact is, even with the banks that we're already cooperating with in terms of supporting their SME customers, we're already seeing many billions of dollars worth of transaction flow possible. And I think that's why John and I took several years of seriously looking at the digital architecture, the legal architecture, how we can pull that together before we felt confident enough to launch the fund, because we wanted to be scalable and really offer a good solution and investment opportunity.
Of the present trade gap, where there's trillions of dollars, which makes it a very wide open space, even if we had billions under management, we wouldn't satisfy what is missing there. Certainly we have origination at the moment, $3 billion worth of transactions, and the fund has the capacity to take that on. That's how it was built.
Yep.
But one of the good things about this is that it's also a societal issue. So SME traders are at the bottom of the pyramid. That they are they're not the multinational traders who are doing all the big oil cargoes, but they're the ones that employ the majority of people and are necessary for doing these small and medium transactions. And so it's quite good really to come into the office and think we're part of a solution that's important to people. It's not just about the buck.
And I think that's, also explains why are we here in Singapore? Why did we launch here and not somewhere else? Thanks to the very strong support of Enterprise Singapore and also MAS here in Singapore, the regulators, they understood what we were trying to build. At that time, early on, they didn't know if we were going to be successful or not, but they understood what we were trying to do to support and fill that gap, which they were concerned with as well, in terms of helping the liquidity at the bottom of that pyramid and the development and growth of new jobs. And so that's why we're here in Singapore. It's a commodity hub, and also the local authorities here got it. They understood what we were trying to do, which was, yes, build a fund strategy for investors, which is low risk in trade finance, asset backed, but also, as John mentioned, deliver a solution to a real problem, which is not going away.
So tell us more about your investor base, and also what are your liquidity terms in the fund?
Well, in terms of liquidity, when we also looked at bank lending, other trade finance funds, there are many that are doing for tenors 6 months, 1 year, 3 years even. But no one was also serving the short tenors. So that's where we looked at the max 90-day tenor. Probably one reason that other funds are not looking at the short dated stuff is because you need to be fast and efficient. And with our digital infrastructure, we could take that on. So we focused on that, max 90 days. The liquidity terms is every quarter day, so every quarter with 30 days notice to take money out. So it looks very much like a 3-month sort of fixed income alternative. So we do have some investors who have come in to actually look at, well, rather than put the cash in the bank, you guys are doing a very steady, stable return, and nice liquidity.
Our returns are very unvolatile, so we're excitingly boring in that regard. As a result, we've been very lucky with the investors that have come into the fund. We started off with our first seeder, who was a family office, and we've now got multifamily offices, fund of funds.
And even now we're starting to see private wealth management banks, private banks coming in and buying shares as well in the fund directly.
And we're hoping quite soon that we'll be taking investment from a supranational, and we've started discussions with some institutional investors as well who are interested to get involved. That's right. One of the things that we found that investors find continually attractive is our mandate, which means the fund can only hold either commodities with an intrinsic value in themselves and an immediate spot market, or cash. So in the event that you need to sell out, you can sell directly into a spot market. Gold has its own value. If you can't sell diesel straight into the diesel market, then it's just not possible. It's a spot market, it's available there immediately. And so as a result, the fund in itself is secure, because it's either cash or things with an immediate cash value. And this level of security is what attracts a lot of the investors. And one of the things we've noticed now is that we're getting our first investors who have looked at our track record rather than meeting us and doing a due diligence exercise onto us, and are investing directly through platforms like Clearstream or DBS. And I think that must be in part to do with the business model that we've adopted, because we're solving what is a genuine business problem. This isn't simply an investment strategy. This is dealing with a real world issue and taking it forward. And the way we're doing it with the emphasis on using technology and modern efficient methods to solve that problem.
That's right. Yeah. No, I mean, I think some of the other benefits at the moment, we've got a huge amount of the world in negative interest rates. So people are looking for fixed income alternatives, cash alternatives. They want to stay liquid, but they want a nice strong return, risk-adjusted return. I think it's fair to say we have a lot of people looking at our fund and comparing us with traditional lenders in the trade finance space. We are doing pretty good against them. But if you then start to understand our business model, where we're owning the assets and actually look at our risk management, we're bringing a further level of security and reducing the risk. If you lend money, you could buy credit insurance, but that also can hurt your returns. And you still have maybe, usually 6 months, right, to wait, if there was a default, to get your money back. We can take immediate action as owners of the commodity to recoup that money. So that again means less likelihood of having liquidity issues for investors when they're investing and taking money out of the fund.
So I can see that what you're doing, your model, your returns are really interesting and highly attractive for investors. And looking at your digital setup, I would also think that you are either prepared for or even already integrating things like big data and blockchain, etc. So tell us more about that.
Part of our success is timing. So we've been able to launch a digital solution now because of the acceptance of digital technologies. 10 years ago, people wouldn't have accepted to use their mobile phone to send a digital photograph of themselves and identify themselves. Now they will. And more across more traditional industries, modern technology and solutions are being accepted. This feeds into things like blockchain and big data.
Yeah. I mean, as John said, the acceptance of technology. A lot of people ask us, why now? How come you're the only people who are doing it right now? It's because of the acceptance of technology. Right now, we're not using blockchain, but we're blockchain enabled. We're watching and making sure that anything we do allows us to interface with banks and other networks that are looking at blockchain. We've automated, as we discussed about our scorecards for scalability, automating the system. As volumes grow, transaction volumes grow, we've already working with artificial intelligence groups looking at machine learning so that we can build automated systems which will already monitor and look at potential issues and further reduce the risks and further improve our processes going forward.
Looking forward, where we see the bulk commodity market, we're engaged in very inelastic transactions, things that ultimately are not going to change very much in the foreseeable future. People will still need to switch the lights on. We need to eat. These basic fundamental raw materials that are being transported around the planet have to be financed and have to be got from the very big producers, so the mine, to the small user. We're engaged in enabling that to happen efficiently, and I don't see any slowdown. In fact, history tells us anything, we become more and more affluent, and technology helps that process happen, which is a good thing.
Yeah, exactly. And in fact, we've been running at this point in time for 1.5 years, and we've already started to see some surprising new trade flows develop thanks to our fundings and trade enablement support. We've been seeing exports out of Africa going into Asia from countries which have never exported to one another, thanks to our support enablement, which they couldn't do because they couldn't afford the bank lending that was offered, even with our various financial guarantees from international groups. But we don't lend, so our risk perspective is much different. So we're able to enable a lot of deals there, which is very interesting. I'm sure we'll see more and more interesting new trade flows develop. So one is supporting the existing trades, But what we didn't expect was that we ended up actually helping develop new partnerships between countries in exports.
That was perhaps one of the most remarkable and rewarding things, that we made a material difference in Rwanda to farmers actually on the ground, and not through some charitable or giveaway type financing, but actually by offering commercial financing through our fund. But because of the use of technology and the granularity and the way we approach it, we actually enabled these farmers to get access to what were prices they could never otherwise obtain. And that had we've been told by the organisations involved, that's had a real material benefit to everyone involved along the way. And as Tom said, it's opened up an entirely new trade route for beans out of Rwanda and into India.
No, exactly. And it's not just about trade enablement, but also technology transfer. We're able to give technical tools to people on the ground to help them manage their transactions more efficiently and effectively, and help document those in a more efficient manner as well, so keeping their costs down, so increasing their margins, which is really great. And this is all on a commercial basis, but it's on we can do it through our ownership of the commodity, our business model, where banks cannot, at least cost effectively, do it just as a pure credit risk.